My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I do want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I have finally figured it out. It took me a little while, but I figured it out. This market is like a needy little baby. Not a cute baby. The other kind of baby. I love my kids, but I especially love them now that they're adults. This market is not an adult. It's a wailing, crying infant. And even when it gets its own way, as it did this morning, it's never content. So after a day where the averages seesawed up and down, sell, a classic pastime for small children, with the Dow ultimately slipping 121 points, S&P declining 0.32%, Nasdaq shedding 0.34%. What does this darn baby want? What's the pacifier that will prevent it from throwing a tantrum and smashing your stocks? Sell. First, let me just say, this ain't no ordinary baby. It's more like a bear cub. And it can't be separated from its mommy. There's only one thing that could be the stock market's mommy. That's the larger, more important bond market. Whenever long-term bond yields go down, the cub cries. Because plummeting bond yields are viewed as a sign that the economy is slowing. And for a baby, that's pretty good logic. Historically, interest rates do go down when we're headed into a recession. It doesn't matter how many times we demonstrate that the U.S. economy is doing just fine. It doesn't matter if the big retailers or the low-end home builders or talented CEOs like Kevin Johnson from Starbucks tell us that business is good. This little cub keeps howling that a recession is inevitable, but howls a lot louder when you take away its pacifier. Just look at what happened today. This morning, stocks opened strong because the bond market was calm. However, it didn't take long for money to come pouring into U.S. Treasuries from overseas because our rates are still much higher than anything else you can get in the developed world. Sure, the 30-year now yields less than 2%, but that's roughly 2 percentage points better than what Germany is paying. All that foreign money, well, let's say the buying has created an inverted yield curve, where short-term rates are higher than long-term ones. Historically, that is a very, very bad omen, but I think it's an anomaly. This time at least, caused by the fact that our rates are so out of step with the rest of the world's. Unfortunately, babies do not understand anomalies. They do not understand the kind of lockstep linkage that says you sell stocks whenever the yield curve inverts. That's what dominates the action now, and I think it will turn out just like the last important linkage, which was oil. You were supposed to sell stocks whenever the price of crude went down because it could be signaling that there's something wrong with the economy. Well, how'd that work for you? Badly. It turns out that there was no meaningful correlation. Oil wasn't going down because there was less demand, courtesy of a weaker economy. It went down because there was too much supply, like the United States selling another 2 million barrels in the market and believing another million's coming. In reality, lower oil was great for the earnings of companies that consume crude, which, by the way, is almost all of them. Then, when oil prices started recovering, that wasn't a bullish signal. It was a bearish signal. It meant we might have some inflation, which then gave the Fed cover to tighten and tighten and tighten some more, which it did, and now we find ourselves in this fix. After this market stopped playing with oil, we got a new linkage. It was the dollar. Ooh, so brilliant. Every time the dollar went up, the averages went down. The dollar linkage made more sense. The linkage made at least more sense than the other. I mean, a strong currency really does hurt American companies who sell lots of stuff overseas, although it's very good for American companies that rely on imports. But the algorithmic traders took over and decided the dollar was the key to the whole market. So they bang stocks down whenever the dollar rallied. Again, though, the dollar wasn't the key to anything. The correlation, bogus. We got used to companies reporting their earnings on a constant currency basis, what they would have made without foreign exchange fluctuations, and pretty much started ignoring it. In fact, companies with sales overseas that got translated back to dollars were some of the market's best performers. If you sold stocks like McDonald's or Procter & Gamble because of the dollar, you missed out on some phenomenal moves. Now the market, it's not fixated on the dollar anymore. It's not fixated on oil anymore. It's just fixated on the yield curve, some kind of crystal ball. Crystal ball that's predicting a recession. But we already have plenty of stocks that are trading like we're headed into a serious slowdown, namely the industrials. Most are down huge from their highs, including the more cyclical tech stocks that need a healthy economy to thrive. So how do we pacify this wailing bear cub? As far as the baby's concerned, the only thing that will make this recession thesis go away is a trade deal. She's not impressed by the strong labor market. Employment is often a lagging indicator. She knows from last week's Fed meeting that the Fed seems pretty oblivious. She doesn't care about the newfound strength in Texas or the Southeast. For this baby, it's trade deal or bust. And that's a real shame because I don't see the trade war with China ending anytime soon. President Trump wants American manufacturers out of the People's Republic. We spoke to Brian Goldner. He's the CEO of Hasbro this very morning. And he told us he's aggressively moving his toy making out of China since Trump started rolling out these tariffs. But Goldner also made it clear that Hasbro has an asset-light business model, meaning they don't own the plants, so they're free to quickly move production. Not many manufacturers are like that. And I think the White House underestimates how hard it will be for these companies to pull up stakes. For now, Trump appears to have the upper hand. We import from them far more than they import from us, so it stands to reason. And we know the Chinese are struggling, so he's got no incentive to deal. But what happens if we get a recession? Then we need to talk about politics, which I hate. With the recession, you're likely to have a Democrat in the White House come 2021. The only question is which Democrat. Whatever your own views, the stock market prefers someone like Joe Biden, who's not really going to rock the boat. But what about the less business-friendly candidates like Bernie Sanders or Elizabeth Warren? If you want to understand their impact on the market, well, I got a way to do it. You know, I like to get things. I like metaphors of stocks. I like Humana. I like Humana as a metaphor for this moment. The health insurance company will be public enemy number one in a Sanders or Warren White House. They want single payer, no room for private insurance. So Humana is going to get clubbed. They'll be hit the hardest when the yield curve inverts because if we get a recession, it dramatically raises the likelihood of a Sanders administration. For the moment, that's all this market seems to care about. So why even bother to own stocks here? Good question. Why deal with the shrinking baby? Excellent question. Because, like the dollar linkage, like the oil linkage, I think the yield curve linkage is wrong. The lower our interest rates go, the better it is for the consumer because people can borrow more cheaply. I think this will be a huge boon, especially to housing. Lower rates are like oil. As long as you're not forecasting recession, they're great for the economy. Who doesn't want a 3% mortgage? Still, the market can stay wrong longer than you can stay solvent. If I'm right, when will you know it? That's the hardest question because we need to see an acceleration in hiring, an acceleration in workforce participation, and ideally some huge infrastructure spending from the government, although politically I think that's very unlikely. Bottom line, until we get some tangible signs that the economy is picking up, you're going to have to get used to the screams of this needy bear cub of the market. But I have to urge you to stay the course because like oil, like the dollar, I do believe the linkage will be exposed as faulty and stocks will remain the best investments. Andrew in North Carolina. Andrew.
Hey, Jim, a big North Kakalaki. Booyah to you and yours.
I'm liking that immediately. What's going on?
Not much. First, I just wanted to say thank you for advocating to everyone to keep their head on straight during market ups and downs.
Thank you. Thank you.
Yes, sir. And I kind of just a question. I've heard you talk a lot in the past about Wendy's.
Yes.
And how it's good chart and dividend make it one of your favorite growth stocks. I just wanted to see what you thought about Wendy's actually going up during this most recent
Wendy's been a star. Wendy's has been a star because they are out executing so many different companies. I think it's a terrific company. I've been behind it now for, I don't know, let's see. Hey, I would say 16 points, and I'm staying behind it. I think there's more to Wendy's. Let's go to Kyle in Kansas. Kyle.
Hey, Jim. Booyah and Rock Chalk Jayhawk.
Okay.
Hey, my question is about big bank stocks with increasingly inverted yield curve, global economic slowdown, and the possibility that profit margins for banks are going to decrease. Should I stay away from big bank stocks like Bank of America?
Okay, here's the problem. I think that the bank situation is much better than people realize, but it won't matter until they report. And until they report, I think they are just going to go down because all anybody looks at is they look at the yield curve and have decided that's all that matters for Bank of America and all the rest of them. So even though I think Bank of America is incredibly cheap, I got to tell you, I do not want you in. So I'm going to say, don't buy. Is that painful? Because I like the company so much. All right, This market will continue to be needy for quite some time, but try to stay strong. I think stocks will remain the best investments. On Mad Money tonight, has Splunk lost its spunk? The stock's been down as of late, but is it a buying opportunity? I'm getting to the bottom of this one with the CEO. And 17 of the last 21 years, stocks have rallied, get this, rallied prior to Labor Day. 17 out of 21. What are the charts forecasting this time? I'll break it down when we tackle the technicals. And it's the world's largest packaged foods company that can offer a real read on the consumer and is real sustainable. Do not miss my sit down with Nestle. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.